Hello, everybody. Today I'm going to be talking about how stocks will make you money. There are several ways to make money investing or trading stocks. The biggest way is through capital gains. And capital gains are when you buy a stock at a low price and then sell at a high price. The capital gains is actually the largest way to make money. It's also the riskiest. um, the next is dividends, and dividends is what I'm going to cover most in this chapter. So dividends, I'll show you on the Investopedia website. A dividend is a distribution of a portion of a company's earnings decided by the board of directors, paid to a class of its shareholders. Dividends can be issued as cash payments or as shares of stock. This article is pretty good. It's all right. It talks about when a company will issue dividends. Now, basically, a brand new company is too busy growing and taking its earnings to grow, expand, to make their business bigger and better. And their goal when first starting out is to grow at a fast pace, so an above average rate. As a company tends to get bigger and meets its full potential and is matured, then it can take its earnings and reward the shareholders by issuing a dividend. There's other things that the company can do as well, and we'll cover that in just a bit. What I'd like to talk about, I'll show you this article, and so you can get an idea of some of the stuff it says. The next thing I want to talk about is the dividend yield. The dividend yield is a ratio that shows the payout of a dividend, basically measuring how large the dividend is. And let me jump over to that. The dividend yield is a ratio that indicates how much a company pays out in dividends each year relative to its share price. So here you can see the equation: annual dividends per share divided by price per share. Now, every day the market's open, the price per share is changing. It goes up and goes down. Once you buy in to the stock, that will lock the price per share down to a constant value. So once you buy it, the price per share doesn't change. After that, it's only the dividends per share that can change. So really the goal is to hold on to the dividend, lock the price in, and as time goes by, the dividend can be raised by the company. They'll issue a larger dividend, hopefully the next year. So what you would do is you would buy in at say a good dividend yield is 3%, and you buy in, lock in the price per share, and as the dividend per share grows, you go from 3% to 7% and 9%, and it gets better over time. So the dividend yield is a measure of how well it's a measure of the dividend. Dividend yield is a way to measure how much cash flow you are getting for each dollar invested in a equity position. measures how much bang for your buck you're getting from dividends. So if there was no capital gain, the dividend yield is effectively the return on investment for a stock. The other thing I like to talk about how dividends or how stocks will make you money is sometimes a company will declare a share buyback program. So they will take the earnings and they will buy back the stocks that are available on the market. So it's sort of a supply and demand type of deal going on where they buy back the shares and it lowers the supply, and thus you have a capital gain because the value of the stock goes up. So you can combine the two. You can have a stock that pays dividends and also has a share buyback program, and that will give you the dividends plus capital gains that are realized from the shares being bought back. One thing to note, however, if a company declares a share buyback program, they don't necessarily have to exercise that. They don't actually have to they can declare saying we're going to buy back some shares, and then they don't have to do it. But the market conditions can change where it's not favorable to do so. Um, so it's just something that you have to follow up on, to make sure that they are buying back the shares and just act accordingly. So I hope this video helps, and thanks for stopping by.